WDFC has outperformed the stock market for the past year, as it returned almost 50% without counting their dividend payments. And we're talking about a dividend payer with solid fundamentals who has been paying dividends for the last 29 years consistently and currently raising the dividends every single quarter. We'll be looking at what Peter Lynch would call the perfect boring stock, since it's very difficult that any new innovative competition arises in the short term, and this company has solid fundamentals and incredible efficiency ratios. Let's talk about WD-40 Company. In their annual report, they say that their activities consist of developing and selling products that solve problems in workshops, factories, and homes around the world. Their star product, of course, is the WD-40 multi-use, which is a lubricant and water displacer, which can be used for absolutely everything. Recently, though, they have been expanding their portfolio through research and development activities and also through acquiring some brands. For example, they launched a specialist line for WD-40, which is the one you can see in the picture, which was better for specific uses. In terms of geographical locations, their Americas represent 50% of total sales, EMEA 36%, and Asia Pacific 14% based on numbers from 2023. And one thing I loved about their annual report is that they are extremely transparent with their future growth strategy. They say it is based on 4 different pillars. First one, it's to lead the geographical expansion of the WD-40 multi-use. They want to get it to more countries, more cities, and more locations, since that would make it more available for customers and improve their revenue growth. Next, they want to accelerate the premiumization of the W40 multi-use. Since it's their star product, they don't want to change it, they instead want to make different versions of it. For example, one where the straw is flexible and can move around, and other different ideas. Next, they want to focus on growing the specialist product category, such as the one we just spoke about. These products target more niche markets, and since they are harder to find products, they could even increase the margins for the company. And finally, they want to turbocharge the digital commerce for their products. The financial analysis is where this company really shines. This company has been selling the same product for more than 70 years, and they still have a return on capital employed of 21%, which is better than their peers and a lot better than the majority of companies in the S&P 500. They have an incredible interest cover of 16 times, meaning that in the short term there is no liability risk. Their cash conversion is 109%, which gives us that nice free cash flow. It has a profit margin of 50% and an operating margin of 17%. Their revenue, their gross profit, and their net income have been growing quarter after quarter. However, this growth has been minimal. One positive take to get from here is that their gross margin and their net margin have actually been increasing quarter over quarter, which is a solid point for the company. And if you look at the comments underneath, their operating income even increased 16% year over year, which I believe is what accounted for the almost 50% growth in stock price. When looking at their efficiency ratios, these are very consistent, and with a return on invested capital of close to 30%, this shows us that the management of this company knows exactly what they're doing. When looking at their fundamental analysis, I have given this company a very solid 7 out of 8. The first point that I give them is that they have a very low liability risk, which is very good to see, and it's something that I really focus on when searching for investments, as I want very predictable, low risk investments. Next, they have a very solid balance sheet, which is great since they will be safer in the long term. And they have great cash flow consistent, which they have managed to grow organically through measures of cost reductions. They have an insane dividend track record of more than 29 years, and they even conduct share buybacks with the rest of the cash flows that they don't invest back into the business. This company has a great existing moat and a huge competitive advantage because they are the only or the clear leader in these type of products. I believe every one of us has at least seen, if not used, that product once in our lifetimes, and me personally, I would be down to pay the premium in price for buying a WD-40 from this company rather than from a company which I don't know, since I already have experience in this company and it is the best product out there. This of course gives them pricing power and the ability to charge higher prices for the same product other brands are creating. And in terms of organic revenue growth, this is the only thing where I have my doubts, since their revenue has been growing extremely slowly and I don't think it has even outpaced inflation. It is very dependent on price surges, and now with inflation they have had a very tough time at raising prices at the same pace as which their costs have increased, making their net incomes decrease year over year for 2 consecutive years. Even though it's only been a couple percentage points, I would still want this sorted out before I make a huge investment in the company. In terms of dividends, here you can see what I spoke about. They have a 29 years paying the same dividend, and they are increasing it at a pretty solid pace every single quarter, as you can see from the image over here. Their dividend yield is pretty high for a company their size and in their niche. They are trading at a dividend yield of close to 1.6%, which would be considered a bit high if you compare it to its historic dividend yield. In terms of long-term analysis, I am a bit worried about the growth potential of this company. It does not follow any secular trends, as it is a very industrial, one-product focused company. The two main growth avenues I see for this company is the ones that they are tackling right now. The first one is leveraging their WD-40 multi-use product, which is of course their star product and the offering that absolutely built this company from the ground up. I believe that if they find a way to make this more commercial by either expanding the amount of uses it can have or just increasing the awareness of the customer, they could grow their revenues even faster. And in the second avenue for growth, it would be based on the new product development. As we have seen, the WD-40 specialist line has been selling well, and if they continue to leverage and raise attention to these products, they could grow their company even further. I think this company is trading at a high PE ratio based on their growth, and this is due to, first of all, their incredible dividend, and second of all, based on their extremely good fundamental analysis. I do think, however, that it is very expensively priced and trading at more of a premium that I would be ready to buy it at. I do, however, think that it's trading at a very attractive free cash flow yield of 2.9% against a 3% long-term inflation rate. And as Terry Smith always said, if the free cash flow yield of a company is higher or close to the long-term inflation rate and the company is growing faster than inflation, this is a good buy. However, I would want to wait to see if this company's price can, first of all, dip down a bit, and second of all, if they can get a more clearer growth strategy, or if we can see the growth strategy actually paying off. I don't see very big risks because, first of all, the huge competitive advantage that they have. Second of all, they operate in an industry which has almost no regulations, and it's very unlikely that any regulations will be changing in the near term. In terms of market, I don't think this is a product that you stop buying in an economic downturn, and I don't think there is a risk for an economic downturn anytime soon. And in terms of performance, this is where I see the main risk, that they'll not be able to grow at a faster pace than they've been doing in the past, and that their net income will keep decreasing as they cannot increase their prices to match the inflation costs. Before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your research before making an investment. But I do believe that this company has a huge moat with a very strong competitive advantage. It provides consistent growing cash flows that are extremely predictable and really, really resilient. And best of all, it has high return on capital employed, which manages to create value for the investor. I believe that this is a great company and I would absolutely love to own it at a good price, as I believe that it is a great investment. However, I do need to see the revenue growth accelerating and them being able to grow their net income again. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.